Welcome to this episode of PhillipCapital's Market Watch. I'm Jia Jia, CFD Dealing Manager from Phillip Securities. Today, I'll be sharing about a seasonal trade opportunity on a specific commodity and how you may use contract for differences or CFD to leverage as an instrument to reap returns. Let's begin. Amidst talks of fiscal policies aimed at reducing inflation and an anticipated economic downturn, it has become common to hear comments about taking proactive steps to protect our investments by re-evaluating our portfolio, avoiding volatile stocks, and adopting shorter-term trading strategies. The big question is, how can we navigate through this wealth of information and make the best move? Whether we are facing a soft landing or a broad economic downturn, life must go on. And at the core of it, there are undisputed essentials that underpin the modern economy we thrive in, such as transportation, industrial, residential, commercial, and electric power. At the center of the global economy's functioning lies a commodity well known to most of us, crude oil. As the world increasingly shifts towards green energy, some may question the relevance of crude oil in today's energy landscape. The simple answer is yes, crude oil remains relevant. As per the OPEC's January 2024 report, the demand for crude oil has remained resilient despite economic fluctuations and is projected to continue in an upward trend over the next 2 years. Additionally, data from the International Energy Agency on the total energy supply segregated by source worldwide between 1990 and 2021 also indicated a shift away from oil, although at a slow pace, decreasing from 36% in 1999 to 30% in 2021. However, in absolute terms, the reliance on oil has intensified as the total energy supply has increased by almost 1.7 times from 1991 to 2021. The market for crude oil remains strong, yet how many of us are aware of an opportunity that may be lurking around the corner to turn this commodity into liquidity to bolster our essential expenditures? Now, let's delve into the monthly chart of crude oil futures, where I'll highlight a price trend that enhances the potential for short-term trading in the crude oil market this season. Analysis of the opening and closing prices in the past 24 years from 2000 to 2023 reveals an intriguing pattern. There is a 66.67% chance the price will rise from the start of March to the end of April. What is also noteworthy is there is a 50% chance for prices to drop in May based on historical data during the same period. In this regard, you may wish to take this timely opportunity to enter into this commodity market at the beginning of March and to consider closing your positions by the end of April to maximize returns, or at the very least to avoid potential losses from the anticipated dip in May. This strategy can be effectively executed with contract for differences, or CFDs. CFDs offer a leveraged route to market participation, allowing traders to gain exposure to underlying assets at a fraction of the cost of direct ownership. By trading on margin, you are able to control a significantly larger notional value with the same amount of capital. However, it's crucial to remember that while leverage can amplify returns, it also increases the potential for losses. CFDs thus require careful risk management to navigate the amplified effects on both gains and losses. There are two oil CFDs tradable on POEMs: WTI crude, also known as US oil, and Brent crude, commonly referred to as UK oil. Both counters are related to crude oil cash indices. To illustrate, let's consider the US oil counter, which trades on a 20% margin requirement. If the price stands at $75, you can open a CFD position with as little as $15 as capital outlay and use it as collateral. Should you choose to close your position at a price of $76, this would result in a $1 profit before fees, or from an initial of $15 investment instead of the full $75 that would be typically required. Furthermore, by leveraging the full $75 as collateral, you could trade up to a value of $375. This leverage means that every dollar increase in the price translates into a $5 return before fees, significantly magnifying the potential for profit. Moreover, one of the distinct advantages of CFDs is the ability to short the commodity, enabling traders to capitalize on declining market prices. This feature adds a versatile layer to your trading strategy, allowing for profit potential regardless of market direction. As we wrap up today's discussion, it's crucial to remember that past performance is not indicative of future results. While the potential for profit in trading crude oil CFDs is compelling, a prudent trading strategy is essential. Implementing an appropriate stop limit order can help manage risk, enabling you to secure profits or minimize losses before the market moves against your position. The Oil CFD MT5 platform offers the functionality to place these stop limit orders effectively, enhancing your trading strategy. Last but not least, it is important to acknowledge that there are risks associated with leverage products such as margin calls and amplified losses. Always conduct due diligence and consider seeking advice from financial experts before engaging a counter or instrument for your investment. With that, I hope the trading insights shared today will be beneficial for your investment journey. If you have any questions regarding CFD trading, you may reach out to my dealing team or myself. That is all for this episode of PhillipCapital's Market Watch. Do remember to like us and follow us on our social media handles, and subscribe to us on YouTube. Thank you for joining us and see you soon.